On March 10, 2000, the Nasdaq Composite closed at 5,048 points, the highest number it had ever printed. Over the next 31 months, it lost 78% of its value, and roughly $5 trillion in market wealth simply ceased to exist. $5 trillion. That was more than the annual economic output of Japan at the time, erased from brokerage statements, retirement accounts, and stock option dreams in less than 3 years. And here is the part that should keep you up at night. The last time technology valuations looked the way they look right now, concentrated, circular, priced for perfection. That number, $5 trillion, is what the bill came to. Nobody talks about this, but bubbles don't announce themselves. They don't ring a bell at the top. On the morning of March 10, 2000, the trading floor of the New York Stock Exchange looked exactly like it had the day before. Paper confetti of order slips underfoot, jackets in firm colors, the ticker crawling green overhead. Across the country in San Francisco, 26-year-olds were signing office leases for $40 a square foot and ordering Aeron chairs by the truckload. The party did not feel like a peak. It felt like Tuesday. That is the anatomy of every bubble ever recorded. The top only exists in hindsight, and the people inside it are the last to see it. So today, we're going to do something most channels won't. We're going to put the dot-com crash on the dissection table, organ by organ, the rise, the warning signs, the collapse, the aftermath, and then we're going to lay today's trillion-dollar AI build-out next to it and compare the anatomy, piece by piece. Not to tell you the market will crash. History doesn't grant anyone that certainty, but to show you exactly what the rhymes sound like, so you can decide for yourself how loud they're playing. Start with the rise, because no bubble inflates around nothing. The dot-com boom was built on something real, arguably the most real thing of the 20th century's final decade. In 1993, there were maybe a few hundred websites in the entire world. By 1996, there were hundreds of thousands. By 2000, tens of millions. Internet usage in the United States was roughly doubling every year through the mid-90s. And for once, the hype merchants and the Avvo engineers were saying the same thing. This changes everything. Netscape proved the money was real on August 9, 1995, when its IPO priced at $28, opened around $71, and turned a 16-month-old company with barely any profit into a $2 billion business by the closing bell. Wall Street took notes. If a browser company could double on day one, what couldn't? What followed was a machine for manufacturing millionaires. In 1999 alone, around 450 companies went public in the United States, and by some counts, more than 100 of them doubled on their first day of trading. The Nasdaq rose roughly 86% in 1999. One index, 1 year, 86%. Companies learned that adding .com to their name could pop the stock. One academic study later found that name change announcements alone produced double-digit gains in the days around them. No new product required. Capital poured into fiber optic cable, into server farms, into anything with a modem. Telecom firms laid tens of millions of miles of fiber across the country on the theory that internet traffic would double every 100 days. A claim repeated. So often it became gospel, even though actual traffic was doubling closer to once a year. And towering over all of it stood Cisco Systems. The company that sold the routers and switches the internet actually ran on. Cisco was the picks and shovels trade of the gold rush. You didn't have to know which .com would win, because every single one of them bought Cisco gear. In late March 2000, Cisco briefly passed Microsoft to become the most valuable company on Earth, worth more than $500 billion, trading at well over 100 times its earnings. Analysts published straight-faced research arguing it would be the first trillion-dollar company within a few years. Remember that. The most valuable company on the planet was not a website. It was the infrastructure supplier. Hold that thought, because it's going to matter enormously when we get to 2025. Now, the warning signs. Because behind the confetti, the cracks were already spreading, and they were visible to anyone willing to look at the arithmetic instead of the narrative. Crack number 1. The businesses didn't make money, and increasingly, they weren't designed to. The metric of the era was not profit, not even revenue. It was eyeballs, growth at any cost. Pets.com sold pet food online and reportedly lost money on a large share of what it shipped because heavy bags of kibble cost more to deliver than customers would pay. The company spent more on marketing than it collected in revenue. That was not a secret. It was in the filings. The market simply decided the filings didn't matter yet. Crack number 2. The spending became theatrical. In January 2000, Super Bowl 34 kicked off in Atlanta, and the broadcast became known forever after as the .com Super Bowl. Somewhere around 14, by some counts as many as 17, internet companies bought airtime at roughly $2 million or more per 30-second spot. Picture it, a sock puppet with a microphone, a company called LifeMinders running an ad that bragged about being the worst commercial on the Super Bowl, money-losing startups outbidding beer brands for the most expensive advertising real estate in America. Several of those advertisers no longer existed by the following Super Bowl, when companies that have never earned a dollar are setting records. For marketing spend, the fuel being burned is not profit, it's investor capital and investor patience. Crack number 3. The gains had narrowed to a sliver of the market. By early 2000, a handful of large-cap technology names were doing a wildly disproportionate share of the index's heavy lifting, while the average stock had already gone quiet. Market breadth, the count of stocks actually rising, had been deteriorating for months beneath a rising index. The crowd was piling into fewer and fewer doors. Crack number 4. The money started getting circular. Telecom equipment makers were lending billions to their own customers so those customers could buy their equipment. Vendor financing, it was called. Lucent, Nortel, Cisco itself extended credit to upstart carriers, booked the sales as revenue, and watched their growth numbers glow. The supplier funds the buyer's purchase becomes the supplier's revenue. The revenue justifies the supplier's stock price, and the stock price raises more capital to lend to more buyers. A loop. It works beautifully, right up until one link in the chain can't pay. And crack number 5, the cost of money changed. Between mid-1999 and May 2000, the Federal Reserve raised interest rates 6 times, taking its benchmark from around 4.75% to 6.5%. Cheap capital had been the oxygen of the entire ecosystem, and the oxygen was being dialed down, slowly, then noticeably. In March 2000, Barron's published a cover story with a simple, devastating piece of arithmetic. A large share of internet companies were burning cash so fast they would run out within 12 months unless they raised more. The article hit newsstands days before the peak. Almost nobody acted on it. Keep those 5 cracks in your pocket. Unprofitable spending, theatrical capex, narrow leadership, circular financing, tightening money. Because in a few minutes, we're going to hold each one up against 2025, and I'll let you judge the resemblance yourself. First, the collapse. And this is where the story gets brutal, because it did not happen the way people imagine. There was no single black day, no one crash to point at. It was a bleed, punctuated by hemorrhages. The Nasdaq peaked at 5,048 on March 10, 2000, a Friday. The following week, it wobbled. In early April, it fell hard, at one point dropping roughly 25% in a single week, with an intraday plunge on April 4th that briefly took it down more than 500 points before a partial recovery. Then, cruelly, it bounced. By summer, the index had clawed back enough ground that the optimists declared the correction over. That bounce, the rally that convinced everyone the worst had passed, is one of the most expensive head fakes in market history because it pulled fresh money in just before the real decline began. Through the back half of 2000 and all of 2001, the floor kept giving way. The dot-coms died first, in alphabetical order indifference. Pets.com had gone public in February 2000 at $11 a share, raising $82.5 million with the sock puppet as its mascot. On November 7, 2000, 268 days after its IPO, it announced liquidation, its stock worth pennies. From the opening bell of its public life to the padlock on the door, less than 9 months. Webvan, the grocery delivery company that had raised hundreds of millions and built automated warehouses, filed for bankruptcy in July 2001. eToys, Boo.com, Cosmo. The list ran into the hundreds. By one count, more than 850 notable internet companies failed in 2000 and 2001 alone. Then the contagion reached the part of the market everyone thought was safe: the infrastructure. This is the wound that matters most for our comparison. Cisco, the most valuable company on earth in March 2000, watched its customers, the startups and upstart telecoms it had financed, stop ordering, default, and vanish. Its stock fell roughly 86% from peak to its 2002 low. In the spring of 2001, Cisco took an inventory write-down of more than $2 billion. Warehouses of routers built for demand that no longer existed. Cisco survived. It was a real company with real products. Its shareholders still waited more than 2 decades for the stock to revisit its 2000 high. The fiber optic networks were real too, and so overbuilt that, by widely cited industry estimates, only a small fraction of the fiber laid during the boom was actually lit and carrying traffic in the early 2000s. The infrastructure outlived the bubble. The investments in the infrastructure did not. The human toll piled up quietly. Somewhere between 200,000 and 500,000 technology and telecom jobs disappeared. In the bust years, depending on how you count. Engineers who had been paper millionaires owed real taxes on stock options that were now worthless. A uniquely cruel piece of arithmetic that bankrupted families who had never sold a share. WorldCom, the telecom giant that the boom had inflated and fraud had hollowed out, collapsed in July 2002 in what was then the largest bankruptcy in American history, taking 17,000 jobs with the first wave of cuts. The Nasdaq finally bottomed on October 9, 2002 at 114, down 78% from the peak, 31 months after that ordinary feeling Friday in March. $5 trillion, give or take, was gone. And the index would not see 548 again until March 2015. 15 years. If you bought the top, you waited 15 years just to break even. Before inflation. Quick aside, and I say this as someone who has read more bankruptcy filings from this era than is probably healthy, the strangest documents are the optimistic ones. Press releases from October 2000 announcing expansion plans for companies that would be dead by Christmas. Nobody inside a bubble believes they're inside a bubble. That's what makes it a bubble. The aftermath rearranged the landscape in ways nobody predicted at the bottom. Because here's the twist the doomers always skip. The bears were right about the prices and wrong about the technology. The internet did change everything, just 5 to 10 years later, than the stock market had paid for, and through different winners. Amazon fell from $106 a share to around $6 during the bust, a drop of roughly 94%, and survived partly because it had raised $672 million in convertible bonds in early 2000, weeks before the window slammed shut. From that $6 low, it went on to gain more than 100-fold and become one of the most valuable companies in history. Google, founded in 1998, IPO'd in 2004 into the wreckage, and built the most profitable advertising business ever constructed on cheap fiber and cheap servers the bubble had paid for. The bubble's corpse fertilized the next era. Both things were true at once. The crash was real and devastating, and the underlying revolution was real and world-changing. Anyone who tells you a bubble proves the technology was fake hasn't read the history. Anyone who tells you the technology being real prevents the bubble hasn't read it either. Which brings us to now, to 2025, and the largest infrastructure build-out in the history of capitalism, the AI data center boom. Here's why this matters today. Take out those 5 cracks from your pocket and hold them up to the light. Crack 1 was unprofitable spending chasing a story. Today, the world's largest technology companies are pouring capital into AI data centers at a pace with no precedent in corporate history. Combined capital expenditures from the biggest hyperscalers running into the hundreds of billions of dollars per year, with public commitments and announced projects stretching towards sums that, depending on whose tally you trust, approach or exceed $1 trillion over the coming years. Some of that spend is backed by real booming revenue, and we'll get to that, because it's the strongest counter-argument. But independent analysts have repeatedly noted a gap, plausibly in the hundreds of billions annually, between what the build-out costs and what AI services currently earn. In 2000, the gap between the fiber laid and the traffic carried took 2 years to matter. The question, the open question, is whether today's gap closes from the revenue side before patience runs out on the spending side. Crack 2 was theatrical capex, the Super Bowl ads of the era. Today's version isn't 30-second spots, it's announcements measured in gigawatts, data center campuses the size of Manhattan neighborhoods, single projects with price tags larger than the GDP of mid-sized countries. The aesthetics have changed. Server halls instead of sock puppets, but the signature is familiar. Spending as spectacle, scale as the message itself. Crack 3 was narrow leadership. In 2000, a handful of names carried the index. In the mid-2020s, the concentration is arguably tighter. A small cluster of mega-cap technology stocks has, in several recent years, accounted for the majority of the S&P 500's total gains, and the largest few names make up a share of the index that exceeds anything seen at the dot-com peak. One chipmaker has at times stood as the most valuable company on Earth, worth several $1 trillion. The picks and shovel supplier of this gold rush, just as Cisco was the picks and shovel supplier of the last one. To be scrupulously fair, today's leader earns tens of billions in actual profit with margins Cisco never dreamed of, and its valuation multiple, while rich, has generally sat far below the 100-plus times earnings Cisco commanded. The echo is in the roll, not necessarily the arithmetic, but the role is identical. The infrastructure supplier crowned king, while the question of end customer profits stays open. Cisco's products kept selling for decades. Its 2,000 shareholders still waited 20 years. Crack 4 was circular financing, and this is the rhyme that has even sober analysts clearing their throats. The modern AI economy features a web of interlocking deals. Chipmakers investing billions in AI labs that spend those billions on the chipmakers' processors, cloud. Providers taking equity stakes in model companies that commit to buying that same cloud's computing capacity. Suppliers, customers, and investors who are frequently the same handful of entities in different combinations, on different lines of the same announcements. Revenue flowing in a circle is still revenue on every income statement it touches. That was true of vendor financing in 1999 too. None of it is improper, and much of it may prove perfectly sound. Strategic alignment is a real thing, but a loop is a loop, and the lesson of Lucent and Nortel is that loops conceal where demand actually originates, right up until one link asks to be paid in cash, and crack 5, the cost of money. The dot-com bubble inflated under falling rates and deflated as the Federal Reserve tightened. Today's build-out was conceived in an era of near-zero rates and is being executed in a meaningfully more expensive one, with a growing share of data center construction financed not from cash flow, but through debt, private credit, and special-purpose vehicles. Markets priced for flawless execution have historically had a narrow tolerance for any change in the price of capital. That is not a prediction, it's a structural observation. The same one Barron's made in March 2000 when almost nobody wanted to hear it. Now the honest counter case, because this channel deals in ledgers, not pitchforks. The differences are real and they are not small. Today's spenders are not cash-burning startups. They are among the most profitable enterprises ever built, funding much of the construction from operating cash flow that the Pets.coms of the world never possessed. AI revenue, unlike eyeball counts, is genuine and growing fast. Leading AI firms report annualized revenues in the billions and climbing. Enterprises are paying real money for real productivity, and the chips, unlike dark fiber, are largely running at capacity the moment they're racked. Measured productivity gains, while debated, are showing up in actual studies of actual workers. And history's own caveat cuts both ways. Amazon was inside the bubble, fell 94%, and still grew 100-fold afterward. Meaning, even if the rhyme plays out, the technology's winners may be standing in this room right now. The internet was real. AI is real. The question was never whether the technology works. The question, in 1999 and in 2025, is whether the price paid today matches the profits earned tomorrow, and on what timeline, and who is left holding the position if the timeline slips. So no, despite what a thumbnail might shout, no one can tell you the AI bubble is about to pop, because no one rang a bell at 5:48 either. What history can tell you is what the anatomy of a bubble looks like. From the inside, real technology, narrow leadership, circular money, spending as spectacle, and a market priced as though nothing will ever go wrong. Every one of those organs is visible on today's scan. So are the differences. Real profits, real demand, real cash. The rhymes are loud. Whether they resolve into the same song or a different one is the open question this decade. We'll answer for us, one earnings report at a time. Are we watching the fiber optic overbuild of the 2020s or the railroad that actually gets finished? $5 trillion says it's worth knowing the difference before the market tells you. If you want to see what happens when the infrastructure itself becomes the mania, when an entire country bet its savings on railway tracks and lost, watch our episode on the British railway mania of the 1840s next, because the AI build-out has an ancestor far older than the dot-coms, and its ending is one nobody in 2025 is talking about.